Welcome back to Bitcoin Forward. I'm Richard Green, VP of Rootstock Institutional, and again, I'm joined by Tony DiCarlo. In our first episode, we spoke a little bit about how miners and Bitcoin holders don't have to sell their Bitcoin to solve a cash flow problem. Since then, market's given us a lot of live stress testing, and within this episode, we're going to dig deeper into how a Bitcoin balance sheet company can manage that more effectively. Tony, good to have you on again.
Thank you, Richard. Good to be here again.
Awesome. Very good. Okay. So we'll kick things off. Same kind of idea as last week, or a few weeks ago, where we went a little bit into the numbers and got a little bit of an overview of the market. Could you maybe kick things off talking about what we've seen within the Bitcoin landscape? We obviously spoke a little bit about relief was coming in terms of hash rate difficulty, but expand on that and then we'll go into some deeper topics.
Yeah, we'll try and keep it succinct here to four main numbers. It's still a really tough environment for most miners. Number one, BTC is on pace for its third consecutive negative quarter. It's the longest losing streak since 2022, and we are thoroughly in the later part of a bear market cycle. Second, publicly traded miners sold more than 32,000 BTC in Q1 alone. That's more than all of 2025 combined. So there's a lot of offloading at the moment, primarily to cover operating costs. Thirdly, miners are still operating below all-in mining costs. They have been for 5 months, and there is a real acute pain now. But lastly, there is a bit of relief. And number four, difficulty just posted its second largest drop of the year, down 10% after an 11% drop in February. And that makes its steepest decline since 2021 China ban. This difficulty adjustment is a real relief. It's less competition for the same block reward, roughly 11% more Bitcoin per share per unit of hash rate, and that's happened overnight. Now, miners who actually convert this opportunity into market share, they're going to be the ones that didn't need to sell in a falling price to cover OpEx, and that's not luck. That's a treasury that had liquidity before difficulty drop happened, not after. If you're capitalized and disciplined, this is the cheapest the network has been to gain market share in years. And if you're not, this relief just delays the same problem.
Thanks very much for that, Tony. On that difficulty piece, would you mind just sharing a little bit more around what we mean by hash rate difficulty? What's the general idea? You know, we're saying that there's less competition for the same block reward, but what is hash rate difficulty? Where's it coming from?
It's essentially an adjustment to keep the Bitcoin network producing blocks at 10 minutes. So 144 blocks a day. When the compute power, when it becomes difficult for the computing network to stick to that, and it's producing only at 8 blocks, a block per 8 minutes, then it needs to reduce the difficulty to get it back into the 10-minute block, and vice versa. If difficulty is too easy and we're producing more blocks than the 10-minute block time that we need to stick to, then it increases difficulty to get it back to that 10-minute block range.
Got it. Understood. And I'm picking up on something that you mentioned at the end of that. You're talking about not about it being managing the hash rate easing. It's about the balance sheet holding the position. We obviously saw in recent weeks strategy selling 32 Bitcoin. And that's raised a lot of questions within the industry about, why or should these businesses that have said never sell Bitcoin actually start to sell it? What's your view on how businesses should be using Bitcoin, active versus passive?
Yeah, I think we touched on this in the last episode where we said that miners will more likely than not start to act like commodities houses. I really do believe that Bitcoin can't be treated as a passive asset that just appreciates, 30% a year anymore. That assumption is what got a lot of businesses into trouble this cycle. Bitcoin now needs to start to earn for its holders in ways that, other than just price appreciation. And that means putting it to work like an asset manager, just like all these commodities houses do. And that's what the miners and anyone holding Bitcoin will do in the future. And that means acting like an asset manager will put any balance sheet that they don't want to sell to work, not trading it, not selling it, but using it as collateral to fund mainly their CapEx and OpEx needs. So for a miner, that's equipment financing, energy contracts, working capital. all the things that actually keep a mining business running through a down cycle. So for me, it's sitting on BTC isn't a strategy anymore. It's an opportunity cost. And I think that's where the real opportunity of Bitcoin backed lending comes in. Richard, do you want to give us a bit of an
Yeah,
overview on
absolutely. I just to jump on that point, I completely agree with that. And I think that the point you mentioned around it being a opportunity cost, I think the thing that we're seeing when we're speaking with clients is that they're getting pressure from other places, whether that be shareholders, whether that be obviously boards and exec committees, as you would do in a traditional business. What are you doing with your balance sheet? How are you making it efficient? How are you utilizing it? You don't just want to, if you were a fiat based business, unless you're Apple or something like that and sat on a huge amount of retained cash, you would be wanting to deploy it into yield, into loans and things. And so I think that that is the shift that we're seeing as well. The businesses are starting to come more into the mindset of, I've been forced due to market pressures to have to do this, and therefore market pressure and also management, external stakeholders, etc., to then be able to deploy it, or being not forced to deploy it, but really strongly pressurized to deploy it.
Yeah, I concur with that. Warren Buffett made a very famous saying in the 2008 crisis, and he said, "When the tide goes out, we'll find out who's got their pants down." And I think we can paint a similar picture with miners in this downturn. The prolonged downturn will expose the miners that don't have a proper treasury plan. On that note, Richard, could you help us understand a bit more how Bitcoin-backed lending works?
Yeah, absolutely. So I think we're seeing a big pickup in Bitcoin back lending. And there are recent reports out that it could reach $1 trillion market size in the near future. And that's driven a lot by what we were speaking about just then. There are market pressures, there's external stakeholder pressures driving, and there's a desire driving people to want to use their Bitcoin in a more productive way. I think that what you're seeing is that you're moving from early crypto lending that was maybe more at a retail base, that was very rate specific and dependent, to a more institutional collateralized credit structure, right? So we've seen some examples out there around securitization, which are being loans added into asset-backed securities. So being kind of packaged up, just like in the mortgage market with mortgage-backed securities. And what that's done is it's provided the institutional grade wrapper for investors, pension funds, and so on and so forth to enter into these markets. Because you've got two sides of the market. You've got those who are obviously wanting to borrow, and you've got those who are wanting to lend. And you've got to meet both of those in the middle with the requirements of each, right? So as a borrower, I'm wanting to make sure that my Bitcoin is in the right place from a custodial perspective with a qualified custodian. I'm wanting to make sure that the rate is, and that the counterparty risk is super low. So that sets me up. But then on the investor or the actual lender side, I'm thinking about, well, how do I enter into this? How do I make sure that the counterparty risk is low, investment grade, BBB plus, and things like that? And so we're seeing more of that institutionalization of the Bitcoin backed lending space because the borrowers are more of a institutional grade product, to be honest. And I think that the thing that I hear quite often from those investors or from those lenders are, we really like the mining business because the mining business gives you exposure to two sides. It gives you a traditional business that has a cash flow component to it and a very predictable cash flow component to it. It's got assets, it's got fixed overheads, it's something that we can understand, but it's also got the Bitcoin and the crypto side to things that we're interested in getting involved in and starting to lend to. And so the combination is a really nice halfway house for these investors who are looking to do those kinds of things. And I think that what we're then starting to see from the miner side is that they are starting to establish long-term relationships with the lenders and then the investor side of things. And they're starting to become more savvy in terms of, I know that I have to, that if I want a loan or if it's going to be securitized, I need to be fit for purpose. And so they're starting to build their businesses around that as well, which is a much more mature way that the market has now gone.
Yeah, 100%. It
And
has come a long way. It's really matured in both depth and understanding. And I think the Bitcoin price actually consolidating is helping miners understand that they actually need to make their Bitcoin work a bit harder.
yeah, absolutely, absolutely. In what you just said there, I think is another really interesting point. Making that Bitcoin work harder. There's the other side to it where we're seeing those Bitcoin miners thinking about making maybe their hardware work harder and splitting out into the AI side of things. And the mining revenue that they're getting from Bitcoin is starting to change, and there's more bifurcation of the market. What are you seeing and hearing, Tony, in regards to the shift or the perceived shift from Bitcoin mining to Bitcoin and AI or full AI?
So this is probably where the biggest opportunity lies, I think. Large operators are pulling capacity towards AI and HPC, and that means that hash rate is leaving a network. That leaves a second group, and that's miners that are staying focused on Bitcoin. And this is where we really believe there is a real opportunity that sits for the smaller and the mid-sized miners to grow and to gain market share. When the big players redirect hash rate to AI, they stop competing for block rewards, but that share doesn't vanish. It redistributes to whoever's left and still mining. So a well-capitalized mid-sized miner is now not fighting the biggest balance sheet for a shrinking pool anymore. It's actually now fighting a shallower field for a bigger slice. And that hasn't been true for most of the last decade. So it really is a transformational shift with hash rate leaving the system. Capturing it isn't automatic though. It comes down to cost control. So you're not the one forced offline in the next squeeze. A collateral strategy that's in place before you need it, not negotiated under pressure, and a treasury policy with real rules. And that's all needs to be done whilst not giving up custody to get any of it. But if you get it right, you are looking at the biggest opportunity this industry has handed out in close to a decade for smaller and mid-sized miners. The share that took the largest operators 10 years to build is now being redistributed, and it won't go to the better miners. It's going to go to the miners that have a quality treasury management and a capital base that enables them to act on this window.
And so, the small to mid-sized miners that you've spoken about there, and coming more into a stronger position, is that something that you think is going to come is quickly? Is it something that they need to do a lot of right now? Is it going to be more gradual? What are you hearing? Are they making those plans to try and take market share, or is it still a little bit reactive and there's still a few things to consider beforehand?
No, I think a lot of smaller and mid-sized miners realize the opportunity. I think they are actively, I mean, we'll get on to the conversations you were having at BTC Prague, that just how many miners are coming to us now looking at funding opportunities. So there is a real awareness of the opportunity. They do need to get financing in place. The ones that do have financing in place and do have a quality treasury management are already taking advantage of this decline in hash rate. This is going to happen over time. AI is a transformation that's going to happen over the next few years. It's not going to happen overnight and stop. So there is time, but for the miners that really want to capitalize on this opportunity, they need to get their treasury management in order and start putting Bitcoin to work properly. But on that note, you talk to funds and treasury teams every week. When a mid-sized miner comes to you and they say, where do I even start with treasury management? What's the first thing you tell them?
Yeah, I think the first thing that I tell them is to have the conversation internally and to figure out what are the needs and what are the wants. And that's the key thing, because you can go out to the market and you can get a plethora of differing offerings from a lender. It could be fixed rate, bi-party, collateral, and different collateralized options. And then you're getting quite confused by all these different things, trying to fit that into a business model that you need to work. And I'd say put yourself into the stronger position and sit down with the business and think, okay, what are the policies that we need to write in terms of putting Bitcoin to work. So what that could look like is, what are the LTV limits? What are the rate ranges that you're looking for? How much do you want to borrow for? What are the collateral top-up triggers that you're thinking about, and liquidation triggers that you're concerned about? If you're concerned that a price drop of 10% in Bitcoin is going to have to cause you to top up your collateral, then you have to go in with that mindset. And I wouldn't say get pushed, because I don't think lenders push. I think there was a lot of great lenders in the space, but don't get pushed into an area that doesn't suit the business. Have very clear policies and guidelines in. Now, a really good way to do that is actually to go out to the market and see what the offerings are, and get different quotes from different providers, and get a real understanding of, okay, well, actually we want this, but we can't achieve this. In terms of, we want to borrow at 3%, right? That's unlikely that would be able to happen without some certain caveats occurring. I think, that what's the goal for the borrower? Is it growth? Is it maintenance? And again, what are the factors that you need to consider there? I think the thing that we see, and the thing that we talk to a lot of clients about, is, especially within the mining community, they all have very nuanced needs. Now, that could be, we want to put future hash rate up as collateral. We want to put hardware down as collateral. We want to put Bitcoin down as collateral. And there are lenders out there who will do those different things. But again, it's about, what do you want to do, and understanding the options that you can do. And I think, it goes to the point that you mentioned earlier around, what did we hear from people at Prague? So Tony and I were fortunate enough to be at BTC Prague, which obviously has a large community of miners and Bitcoin balance sheet holders. And the biggest questions that we were hearing and receiving were around that. What can I use as collateral? What are the rates? And the sheer number of those. So we're really positioning ourselves to try and help those kinds of businesses to be able to get an understanding of what those are. So, that's where we can have a conversation and go, look, this is the kind of thing that you're looking at within the market. These are the kinds of things you can do. And these are what we can offer from our side. And I think that's the real key thing. You do not want to enter into a agreement with a lender where you are a number and you are just a switch that can be switched on and off. Want to be there where you can have that consultative conversation and actually understand, okay, if this happens or this goes wrong, can we talk about it? Can we see what the possibilities are? Can we work something into the actually initial term agreement that helps both parties? And I think that's the key thing. I think that you are seeing those small, mid-sized miners being the ones who are having the conversations. And interestingly, it's the mining pools as well. So the mining pools are interested in these kinds of agreements and lending agreements where they can say to the miners who are sharing the pool, this is something that we could offer to you via a third party or something like that. So there really is a focus on being able to provide that. I think the key thing is just making sure that it's provided by the right partner under the right terms, and that you understand the terms based on a very strong internal governance policy procedure. Because the last thing that anyone wants to happen within this space is something goes wrong, and it goes wrong for everybody. And I think that the industry now understands that. And from a lender's perspective or from a borrower's perspective, I think there's a clearer understanding of what people actually want and need.
Yeah. So
I mean, you were in Prague as well, Tony. Anything that you would add on top of that you had conversations regarding?
yeah. So a bit before I go into Prague, I completely concur. It's a good lender can add so much value. A good lender can understand the risk profile. It can understand the goals of what a miner's trying to achieve, whether that's hedging against liquidation risk or whether that's achieving the lowest rate. It's up to a good lender to individualize these deals and not just blanket cover them so that it suits the counterparty. On BTC Prague and Bitcoin Corporate Day, they were fantastic. And we were having a lot of conversations that back up what we're talking about today with smaller and mid-sized miners, all focused around either releasing liquidity with Bitcoin as collateral or trying to help them fund CapEx and OpEx options via a range of collateral requirements. So lots of really fruitful and ongoing conversations, but the sector is quite active now in looking for liquidity requirements. What about you, Richard? What did you find?
Awesome. Yeah, no, I think that those are the kind of the things that you mentioned and the points mentioned earlier were the key things. I think that there is this underlying, the great thing about conferences like that is there is, well, what it is there isn't just consistently radical optimism. There is considered optimism. And I think that that used to be what the events were like. And everyone was talking about how, Bitcoin is going to go to however much. I think that obviously there are some conversations that are still there, but it's a lot more practical. And it's a lot, I would say, more smaller conversations and intricate conversations about how does this work and what's happening. And people are wanting to go deep into those. And so, no, getting out and speaking to clients around there is always a great thing. So I think that's all we've got time for in this episode. But yeah, I think to recap on that, in the first conversation we had, it was a lot about miners not having to sell. I think in this episode, what we wanted to talk about was obviously that miners can treat Bitcoin like a treasury asset as long as they have real clear policy, discipline, infrastructure, and understanding. And those who do that can turn a downturn into a structural advantage, as you heard Tony speaking about earlier, with the small to medium-sized miners being able to take a chunk out of those larger miners who might be pivoting away into AI. Obviously, from the market side of things, the lending growth could be huge, $1 trillion, and the infrastructure is now there. And so this is something that we'll continue to investigate in upcoming episodes. But Tony, I'd just like to say thank you as always for your time.
Thank you, Richard. Pleasure being here.
Great. And we'll speak to everybody soon.